We're jumping straight into Nebius today. Everyone is watching the stock price volatility. I mean, it's up 216% year to date, even with that recent 30% pullback.
It's been wild.
But the real story, the signal that, really matters, is that their revenue growth was limited only by the capacity they could bring online.
Exactly. It's not a demand problem. It's a supply problem.
Right, a physical manufacturing constraint. And that is a critical sign that demand is just wildly exceeding supply.
And that imbalance is exactly why this company is so fascinating right now. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you're enjoying the show, make sure to subscribe and hit the like button. It really helps the channel. And definitely let us know in the comments which stock you want us to simplify next.
All right, let's look at the bull and bear case for Nebius right now. This is a perfect example of a company in hypergrowth mode.
True hypergrowth.
But the entry ticket to that growth, the capital expenditure, is so massive, the market is still trying to figure out the short-term pain versus the long-term gain.
Okay, let's unpack this. We have to start with the bull case, because the numbers from Q3 2025 are they're explosive.
They really are.
They clocked in $146 million in revenue. That's a 355% year-over-year growth rate.
Right, and a number like that is always a headline.
Yeah.
But here's where it gets really interesting if you dig just one layer deeper.
Go on.
The core infrastructure segment, that's the actual AI compute capacity, but 90% of their revenue, it grew even faster.
Wow.
It accelerated to 400% year over year. So this tells you their primary engine is not just growing, it's accelerating its dominance.
And the key takeaway here, which management couldn't stop repeating, is that they are completely capacity constrained.
Completely.
They are not struggling to fill data centers, they are struggling to build them fast enough. So if we're looking for a moat, is this scarcity actually creating one?
Oh, absolutely. Think about what they're selling. It's not generic cloud storage. This is highly specialized infrastructure for training the biggest AI models out there.
Right.
So that scarcity creates a powerful, immediate moat. Every single rack they install, every unit of compute, it's sold out instantly. It's the definition of high demand.
And that scarcity must lead directly to switching costs, which I hear are just notoriously high in this space.
They're massive. I mean, when a major customer, and we're talking about giants like Microsoft or Meta, integrates Nebius, they're not just buying hardware.
It's the whole ecosystem.
The entire software stack, the architecture, the cost in both time and, just pure effort to untangle that and move to another platform is substantial. It locks them in.
So this isn't just a partnership, it's a strategic entanglement. It gives them multi-year revenue visibility, which is exactly what the market needs to see.
And that brings us to the commitments, which really are the anchor for the entire bull case.
Okay, lay them out for us.
Nebius has locked in $3 billion in committed revenue from Microsoft and another $3 billion from Meta. Each. Both over 5-year periods. And these aren't just, handshakes. These are contractual revenue floors.
Let's just pause on that. $6 billion in committed revenue from two of the most sophisticated tech buyers on the planet. If that's the foundation, what are they building on top of it?
The structure they're building is, it's extraordinarily ambitious. Management just gave their 2026 annualized run rate target.
The ARR target.
Yep. They're guiding for $7 to $9 billion.
I mean, that number is breathtaking. Compared to where they are now, what kind of jump is that?
It's a jump of between 7.8 and 9.8 times their current guidance. It's almost a vertical line on a chart.
So if they pull that off.
If they pull that off, it absolutely validates their current market cap.
Yeah.
But that word if, that's where we have to pivot, because that introduces all the major risks.
Right. You just don't build that fast without paying a steep price. And that's what drove the recent stock pullback, right?
Yeah.
The net loss.
Post-earnings, the stock took a hit because Nebius reported a pretty significant net loss of $119.6 million in Q3. On paper, that looks bad.
It spooked the market.
It did, but you have to understand the why. This loss is a direct symptom of aggressive and I'd say necessary reinvestment.
To meet that demand.
They jacked up their capital expenditure guidance for 2025 from an already high $2 billion to an astonishing $5 billion. They're in build mode, and that means burning cash now.
So it's a strategic trade-off. They're choosing market share and locking in these huge customers now over showing a profit in the short term.
That's it. Exactly. You're building the factory. You feel the cost of construction long before you sell the first product. But And this is a really important counterpoint.
Okay.
We need to look at the underlying health of the core business.
Right.
Management is guiding to slightly positive adjusted EBITDA for the whole company by the end of 2025. That shows they're managing costs.
Okay, so there's a path to profitability.
More than that, if you isolate that core infrastructure business, the one growing at 400%, it's already highly profitable. It has an adjusted EBITDA margin of nearly 19%.
That is a crucial detail. It means the business model works. The losses are just from hitting the accelerator as hard as they possibly can.
And that accelerator, that $5 billion in CapEx, needs funding. Which brings us to the big risk for shareholders: dilution.
The ATM program.
The at-the-market equity program, yeah. They're authorized for up to 25 million new shares.
Can you just quickly break down what an ATM program means for someone holding the stock?
Sure. It just lets the company sell new shares into the market gradually when the price is good. Instead of doing one big disruptive offering, it's more flexible.
But it still means more shares out there. What's the potential dilution?
That program could dilute current shareholders by about 8%. So yes, there's selling pressure. But for a capital-intensive business like this, it's seen as a pretty smart way to raise cash. It's better than taking on billions in high-interest debt.
So we have the growth, the committed revenue, the financing plan. But the ultimate risk, the one that decides if they hit $9 billion or not, is just pure execution.
This is it, bar none, the biggest risk. Hitting that target isn't a sales challenge. It's a monumental operational and logistical challenge.
You're talking about the supply chain.
Sourcing the most powerful GPUs when everyone on Earth wants them. Securing land, power, permits. Building these complex data centers. A delay in any single part of that
Ripple through the whole schedule.
Exactly. If the Microsoft or Meta deployment slip by even 6 months, that $9 billion target is gone. And the stocks see a major correction. I mean, 30, maybe 50%.
But the contracts, they do mitigate that a bit, right? They provide that floor we talked about.
They do. That's the key mitigation factor. That revenue is locked in. So even if deployment slows, there's a baseline value there that you don't have with other hypergrowth companies. It makes the volatility a little more manageable.
Okay, let's pivot to the technicals. The price action has been all over the place. The stock is trading around, what, $87.59 right now? What are the key levels people should be watching?
You have to watch the support level that's held up during this pullback. That's the 200-day simple moving average, right around $83.16.
Okay.
The price has bounced off that level multiple times, which suggests big institutions are buying the dips there.
And what about on the upside? Where's the resistance?
Near-term resistance is clustered around the $98 to $100 level. That's where the 50-day moving average is sitting. If it can break and hold above $100, that's a strong signal the market is regaining confidence.
And we have to talk about the volatility. The beta is 3.83. Can you translate what that means for someone new to this kind of stock?
Sure. A beta that high means that if the whole market, like the S&P 500, moves 1%, you can statistically expect Nebius to move 3.83% in the same direction.
So it's a leveraged bet.
A highly leveraged bet on the sector. If the market drops 10%, you could see this stock drop nearly 38%. You absolutely need a high tolerance for swings here.
Understood. So what are the upcoming catalysts, say, between January and March 2026 that will prove if they're on track or not?
First up is the Q4 earnings release in late January. The mission there is simple. Confirm they hit their ARR guidance of $900 million to $1.1 billion. That's step one.
And step two is the guidance for the next year.
That's the real test. On that earnings call, they have to confirm that massive $7 to $9 billion target for 2026. Any sign of them backing down from that will be punished severely by the market.
So if you put it all together, the huge customer wins, the profitable core business, but then you offset that with the massive spending and the execution risk, how do you summarize the overall sentiment?
I'd say the sentiment is somewhat bullish, but it is very conditional. The reward is enormous, but the valuation depends entirely on perfect execution. There's almost zero tolerance for operational failure.
That's the key takeaway right there. The whole Nebius story just boils down to whether management can execute on this enormous 2026 target while juggling this unprecedented CapEx plan. It's a race. Now, let's leave you with one final thought. We've established the huge demand, the high switching costs, the scarcity of this AI compute capacity. What happens? What happens to the stock if a major cloud provider, maybe one not yet named, decides waiting for Nebius to build is just too slow?
That capacity is strategic gold right now.
Okay.
And if getting it becomes an existential need for a competitor, then M&A becomes a very real speculative catalyst.
A buyout.
A massive cloud provider might just decide that an acquisition is the only way to guarantee that capacity pipeline, short-term costs be damned, and that changes the entire valuation equation overnight.
That's the lowdown on Nebius for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.